Okay, any issues on what we spoke about last week, which was kind of just introducing this money stuff? No? Okay. So really what we did was we just did introduction to some theory and some terminology. We spoke about what the purpose of the chapter was, and it's quite a long chapter. There's a lot of different things that we're discussing. We're introducing you to the idea of money, what constitutes money, what are the functions of money. Eventually we will talk about the banking system, we'll talk about the demand for money and the supply of money, talk about the money market and how the demand and the supply come together. And the interest rate is the thing that equilibrates these two different forces. So equilibrium, we're going to talk about it in the way that we have previously, describing it in words, talking about it in maths, and sort of showing it graphically as well. And then the whole chapter finally concludes with a brief discussion on the quantity theory of money. So that's kind of the broad scope of the chapter, and it is, as I say, very broad, a lot of stuff to cover. So we spoke extensively about what money is, what are its functions. We define money in terms of its functions, essentially. And in terms of measuring money, there are two different components to the modern money supply. So if we just call the money supply M, then it's made up of two components, cash and deposits. Okay, so deposits here meaning deposits in the banking system, cash meaning notes and coins that are printed either by the Reserve Bank or the Mint. In other words, these are cash is made by the state, deposits are made by private institutions. In South Africa, we have three main measures of money supply, M1, M2, and M3. We also have something called M1A, but it's not that important. So M1 is basically just cash and call deposits meaning deposits that are available immediately. You go to the bank, you put your debit card into the ATM, you withdraw cash, that's a call deposit. It's available to you immediately. M2 includes cash, call deposits, and slightly longer term deposits. So if you have to wait slightly longer, in other words, short and medium term deposits. So if you have to wait for a day before you get your money, if you have to notify your bank, if you have to wait for a week, that sort of thing is included in M2. And then M3 again includes all of those things, cash, call deposits, short term, medium term, as well as longer term time horizons. So if you need to wait for like 3 months or 6 months or something to get your cash, then we're talking more like M3. So in other words, as we move from M1 down to M3, we get less and less liquid. I had mentioned that there were two other measures, M0 and the monetary base, MB. And then I wasn't 100% sure exactly what was included in M0 and what was included in the monetary base and what the difference between the two was. So I just double checked, and in fact the monetary base and M0 are actually two different names for basically the same thing depending on which economy you're looking at. In other words, different countries might use M0 or they might refer to the money base, but they're basically the same thing. And so if I were to rewrite this down here, basically M0, the monetary base MB is equal to M0, which is equal to the notes and coins in circulation. So notes and coins in circulation, which means like in your wallet or in a till at the shops. So it's all those things plus notes and coins in reserve. Okay, so notes and coins in circulation plus any cash that's held in reserve within the banking system. So that's your monetary base M0. When we talk more about the money supply and we talk about the monetary base, generally the way that we just, to make our life easier, what we assume is that notes and coins in circulation is 0, which means that essentially the monetary base is just any coins held within the banking system. But more technically, it's the notes and coins in circulation and the notes and coins held within the banking system. right? We spoke about why a debit card and a check or a credit card are not actually money. They're just kind of ways of accessing money. In other words, a debit card just allows you to transfer a debit balance from somewhere in the banking system to somewhere else. The card itself is not the cash. It's the underlying deposit that functions as money. Then we kind of got to this point where we said there were different types of depository institutions within the economy, and so what we need to do is begin our discussion at this point describing the different types of institutions within our monetary system. Any questions at this point? No? Cool. So when we're talking about a depository institution, deposits, right? In other words, it's any kind of firm that takes deposits. Okay? If you're taking deposits, you're usually on the other side also making loans. These are the key attributes primarily of banks. Okay? So our first kind of depository institution is a bank. And then they distinguish between a commercial bank and a mutual bank. In South Africa, there's not really much of a difference. It's not something that would really mean much in your life. All our banks are basically commercial banks. Our banking system doesn't really have mutual banks, at least that I can think of. I can't think of any. Then other than the sort of our big four commercial banks and a couple of smaller commercial banks, we also have the post bank. In other words, you can get banking services from the post office. If you've been following the SASSA business, then the payments to the social grants, you guys are aware of this whole controversy and the payments potentially not happening, and they're looking at ways in which they could do this other than using some private third party. And they're talking about using either the banks, the commercial banks, or the post bank, which is the post office. And then we also have something called the land bank, although here it's the land and agricultural bank. What the land bank does is, as it says here, primarily provides financing for agricultural activities. In other words, the land bank primarily lends to farmers. We also have sort of, in terms of our economy, you know, we've kind of got like a very first world, if you want to call it that, or so we say, developed economy, and we've got a very sort of developing, or what you might call third world economy. In other words, we've got a large rural sort of economy, and then we've got our urban centers. And a lot of the rural areas, should we say, are under, they work under a sort of political system that's basically very different to a democracy. In other words, you have land that's not necessarily owned by individuals, and it's controlled by sort of a tribal body, which would involve sort of a chief or a high-ranking individual and a whole lot of other sort of high-ranking officials, and those people control the land within that area. So it's a kind of an autocratic system within our democracy. So if you live in the rural areas, you're probably under the control of some kind of chiefdom. And the way that property rights work within that kind of legal system is different to what you would understand perhaps if you owned a house like in the city. And because of that different economy, there's also kind of this bank, there's a sort of a, call it like a rural banking system, which operates very differently to our commercial banking system. And it specializes on making loans to individuals that live within that area. And that would put up, say, collateral in the sense of you live in a rural area, you live in a property in the rural area, you don't own that property because technically it's owned by the community, and it's the chief that controls, or not the chief necessarily, but the tribal body that controls access to land and who has property rights over land. So if you want to get a loan and you want to pledge that land as collateral, you can't really pledge it as something that you own because you don't really own it. Anyway, so we have that additional banking system. It all gets very complicated. So when our illustrious president needed money to pay for his very expansive house, he needed to borrow 7 million rand, and he got a 7 million rand loan from one of these banking institutions, which was all very dodgy. But yeah, that's for interest's sake something that operates outside of the sort of urban centers, which is interesting if you ever wanted to do some cool research onto banking and how it works outside of the formal banking institutions. That's a really interesting thing. You also get stuff like stockfels and things like that, which are all really wacky stuff. I mean, if you're not used to it, it's fascinating. Anyway, what does a bank do then? The aim of a bank as an institution, if it's a firm, if you recall from microeconomics, what does a firm try and do? The idea is that the firm tries to maximize the net worth of the shareholders. In other words, it's profit driven. It tries to make profits. Right, so what it does is it lends at a certain interest rate. It lends money to people at a certain interest rate. So in other words, any loans that the bank makes, it makes at a certain interest rate. Whereas any money that it is borrowing, in other words, any money that it has on deposit, it pays a different interest rate. So it pays a low interest rate on deposits, it charges a high interest rate on loans, and the difference between those interest rates are essentially the bank's profits. That's its profit margin. That's how it makes its money, and the difference between those two interest rates. So there's a kind of an arbitrage that happens there. However, the bank obviously must be prudent. It has to think carefully and manage properly. First of all, how people have access to deposits. In other words, if it has deposits in the system and people are able to withdraw those deposits on demand, for example, then it needs to manage that process. When do people want to convert deposits into cash? How frequently and where? And then balance that against the fact that it's lending out, or it's got loans to on the asset side of its balance sheet. The loans tend to be long term, the deposits tend to be short term. That can lead to a liquidity issue for the bank. In other words, if the bank's loan is a 20-year loan, and someone's got a deposit that matches that loan, and that deposit is a call deposit for $1 million, someone wants to withdraw R1 million tomorrow, the bank has to be able to make sure that they've got R1 million available for that guy to withdraw. If they don't, they have a problem, because they've got R1 million asset which is not held in cash, which is the loan. And if someone wants their deposit in cash and all the bank has got is a loan, then what the bank has to do is try and sell that loan in the market, convert it to cash, and then give the cash to the depositor. If it needs to sell its loan in the market and it needs to sell it urgently, it's probably not going to get the full $1 million for the value of its loan. It's going to have to sell it at a lower price. So if it's got R1 million loan and it sells it in the market at 800,000, it makes a 200,000 rand loss, first of all. Secondly, the deposit guy, the guy who wants to withdraw the deposit that's valued at $1 million, is now only going to have cash of 800,000. He's not going to be happy. So the bank has to manage that process, has to make sure that if it's got a loan book of whatever it is, a couple of billion rand, and it's got deposits of a couple of billion rand, needs to make sure it's got enough cash that any depositors on any given day wish to withdraw cash, there is cash available for them to withdraw, so that the banks don't have to sell loans into the market at a loss in order to convert them into cash. When they do need to do that, it's called a fire sale. And a fire sale is not good for a bank, and fire sales are usually things that happen when banks are in trouble. So when you have fire sale situations, then your banking system is not in a happy place. The banks also make losses, and when banks are making losses and banks are not in happy places, then people who have their deposits in banks tend not to want to keep their deposits in banks, and so they come to the banks and withdraw, which just then exacerbates the problem even more. It means the bank needs more fire sales, more cash, more losses, which means more people come and withdraw their deposits, which means you have banking crisis. Everyone wants to withdraw their deposits at the same time, the banking system collapses, and you have a big problem. So there were banking collapses, 2007 and 2008 in the US. when we had the financial crisis, that spilled over into Europe, and you had big problems in Greece. I don't know if you're currently aware, but in Spain and Portugal, currently big problems. If you have deposits in those large number of those banking institutions, you just don't have access to your deposit. You may not withdraw your deposit. Yeah.
2 years ago in Greece, they put a limit on how much
Yes.
you could withdraw per day.
True. Yeah.
So would that then actually, because then people go crazy because then they can't access their money at all.
It's true, but they also can't all access it on the same day, so it gives the bank some time to try and get cash and to make plans to get cash for people. A similar thing happens about 3 and a bit years ago, and there's a banking system, and I'm just trying to think where it was now. Not Greece, but like next to Greece somewhere, a little island, I think it was like Cyprus or something, where they had a whole lot of really, their banking system basically holds a whole lot of deposits of wealthy Russian oligarchs, and they had a banking crisis, and they just said, cool, you can't withdraw your money. So you just had like all these private jets flying in trying to withdraw boatloads of Russian cash, but just, it wasn't able to. They didn't have it there. Anyway, so currently still banking crises happening in Portugal and Spain today. The most recent sort of potential banking crisis that we had was the African bank saga. I don't know if anyone ever had an account with the African bank or not, but that was about nearly 2 years ago, about 18 months I think, or 2 years ago, let's say. African bank collapsed, and the Reserve Bank and the rest of the commercial banks kind of put this plan together for not rescuing African Bank, because African Bank was not rescued, but it was sort of taken over and dissolved. And what they've now done is they've split African Bank into 2 entities. One entity kind of has the deposits and any good loans that African Bank had, and then there's another entity which is just made up of all the bad loans that African Bank had. And then these 2 things are now operating as separate entities. Obviously the one is a pretty rubbish entity and the other one is a pretty good entity, and then if you were a shareholder in African Bank, you potentially lost a lot of money. As a depositor though, you haven't lost anything that I'm aware of. They sort of had a guarantee system. Is that a question? No? Okay, so anyway, profit versus prudence, it's a balancing act. The bank needs to manage its operations, because if it doesn't, it's pretty easy for a bank to go out of business. Something that is a liquidity crisis can quickly become an insolvency crisis. So what is it that a bank does? Like we've provided a description of what it does, but the actual mechanism, how does it do what it does at a technical level? If we go to this third bullet point here, a commercial bank places the funds that it receives from depositors and other banks, and other funds that it borrows into 4 types of assets. In other words, if we're going to look at a bank, it has a balance sheet. So we've got bank, just as any kind of accounting entity, has a balance sheet. It's got assets and it's got liabilities. The liabilities on this side of its balance sheet are primarily deposits. That's mostly what banks have. So, right, commercial bank places funds it receives from depositors and any other funds that it borrows. So it might have other kind of, apart from deposits, there are other kinds of short-term liabilities that people can have with banks. But we'll just focus on deposits. And what does it do? It's got to match those deposits with some sort of asset. What are those assets that a bank holds? So a bank, first of all, holds reserves. Reserves are notes and coins, which can either be in the bank's vaults or they can be on account at the South African Reserve Bank. So in other words, some of its assets, cash. Okay? At least one type of asset that it holds is cash. Okay? And that cash is what we would call reserves. Secondly, you can hold something called treasury bills. Okay, what are treasury bills? In other words, bonds. It can use those deposits to buy bonds from the government. Let me just move all of this stuff up a bit. Okay, so it can hold bonds, and these are government bonds, usually. So that's treasury bills. Then, of course, it can invest in securities which are longer term bonds. In other words, it can hold other types of government bonds. But primarily what it's going to have then are loans. In other words, you want to go to the bank to borrow money, this is where you appear in the bank's balance sheet. You are a loan. You're an asset to the bank as a loan. So any deposits that the bank gets are either matched by cash or deposit or bonds or loans. We'll see how this whole thing balances itself just now. Why does a bank have this structure? What does it do? What are the benefits that it offers? Okay, in other words, benefits. Can create liquidity. What do we mean by create liquidity? Well, if we look at these loans, like I said previously, these tend to be fairly long term. In other words, let's say that these are 20 years plus, whereas the deposits tend to be call deposits, in other words, very short term. So their liabilities are short term, the loans are long term. What that means is it improves the liquidity of the loans. It converts the loans from something that is a very long-term loan, long-term financial instrument, into a deposit which is a very short-term instrument, right? So in other words, while you hold a deposit, you are essentially holding a loan in a bank, right? So your deposit is matched by a loan. In other words, someone has borrowed that money and they've purchased a house. You hold a deposit which is backed by that house. If you want your money, you don't go to the guy who owns the house and say, listen, I need money, sell your house and give me the money that I'm owed, right? What you can do is you just take whatever value you have in your deposit and you can go to someone else and say, I would like to purchase something from you. Why don't you take over the value of my deposit and I'll take those goods? And the other person says, okay, no problem. I'll take over the value of your deposit. So whatever was the value in your deposit gets transferred from your deposit into someone else's deposit, right? In the meantime, the guy who bought the house still owns the house and has not had to convert the house into cash in order for you to make that purchase. After you've made that purchase, someone else holds the deposit value. They can take that deposit value and purchase from someone else, right? So that deposit can circulate as something very liquid, even though it's backed up by something that's very illiquid. So what do banks do? They can create create liquidity by what they refer to here as borrowing short and lending long. In other words, borrowing short means deposits, right? These are deposits, they're short term. And lending long, these are the bank's loans, which tend to be long term. Of course, in this bank's balance sheet, these loans tend to be lots and lots of different types of loans from lots and lots of different types of people, which means if you're holding a deposit over here, if any one of these loans defaults, that's not a big problem to you because the other loans are hopefully not defaulting, right? In other words, any risk involved in a single loan is not a kind of risk that you bear, you only bear a very small portion of that risk. So what banks do essentially is they pool risk. Okay? And by pooling risk, it means you have lower exposure to any kind of default risk. The advantages of being able to provide liquidity and to reduce risk exposure is that banks therefore lower the cost of borrowing. If you want to borrow from the bank, you can generally borrow at a lower cost than you would be able to, say, borrowing from someone else. And also, if you're holding a deposit, the value of that deposit is less exposed to risk. So what that exposure to risk to you, in other words, the cost of that risk exposure to you is lower. In other words, there's a lower cost of monitoring borrowers, right? So in other words, if someone's going to default, you want to make sure they don't default, right? So you're going to be monitoring anyone that owes you money to make sure that they're going to pay you that money back. If a bank lends out money to lots and lots of different people, that employs people that are good at monitoring and that are good at making people repay their loans, then you don't have to worry about doing that yourself. The bank does it on your behalf. You pay the bank to do it, and in theory, you pay a lower cost for doing it than you would yourself. Because of the lower risk, there's less cost generally. So you're going to have to monitor less. The costs to you of monitoring are much lower. And then, given that the banking system is crucial to financial stability, which is then crucial to economic stability, the entire depository institution, the entire financial system is regulated. Because if the banks fail, then our payment system fails, and if our payment system fails, our economy takes a big knock. So the entire system is very heavily regulated, and the primary body that does the regulation is the South African Reserve Bank. If you are in the US or if you're in the UK, then it's not only the central bank that monitors. They have something called, I think it's called Twin Peaks regulation or something. You have, I'm not 100% sure exactly what the Twin Peaks regulation involves, but it has to do with regulating the financial system as well as things like insurance companies. And what happens is you don't just have the central bank doing the monitoring, the regulation, but you also have these other bodies like in the UK you had the Financial Services Authority, the FSA, I think, which I think became the FSB, or the FSB became the FSA at the time of the financial crisis, basically because the FSA or the FSB were useless. They didn't know what they were doing. They didn't know how to regulate. Yeah.
Can you insure money?
Insure it, absolutely, yeah. In what sense though?
Hypothetically speaking, the people that, what is it called, fidelity?
Yeah.
They deliver money
Okay.
and stuff. When it gets stolen or something, do they have to repay it, or it's a loss to that company, or they insure the money?
Yeah. You can insure money, and there's different ways to insure money. What you're describing is a very particular kind of insurance. So if I'm carrying money around like in a briefcase and it gets stolen, it's like if I'm carrying my computer around and it gets stolen, I can insure my computer, right? If my computer gets stolen, the insurance company reimburses me whatever the value of the computer is. If I'm carrying a briefcase of cash, of cash, I can insure it. If it gets stolen, same thing, the insurance company just repays whatever the value is of the stolen goods, right? So it just gets treated as any other kind of stolen good. So that would be one type of insurance. The other type of insurance, however, is deposit insurance. So in South Africa, we don't officially have deposit insurance. There are discussions at the Reserve Bank currently about whether we should have insurance deposits. There are certainly some benefits to deposit insurance. There are also some negative issues. But specifically like in the US, you have, I think it's up to about $100,000 deposit is insured by the state, so by the Federal Reserve, so by the central bank, right? So what each bank does is they essentially pay like a premium, an insurance premium to the Reserve Bank. If the bank goes under, anyone who has a deposit at that bank up to a value of $100,000 will get paid back like an insurance policy, right? If you've got more than $100,000, then you don't have insurance. So what a lot of people do is they just have multiple bank accounts, with $90,000 or whatever in each bank account. But the banking system in the US is very different to the banking system in South Africa. They have a ton of banks, like I don't even know exactly how many banks there are, and there's constantly banks opening and banks closing. In the financial crisis, there were like a bunch of banks that went under, and they tended to be relatively small banks. So you have basically like a bank within a state that operates within just that state in the US, right? And they still use checks. They still people have checkbooks and you pay stuff with checks, right? Things like debit cards, it's like not really something that they use. Online banking, it's like, whoa, what is this wizardry, you know? EFTs, they don't really use EFTs. It's like, rather pay with a check. Don't pay with an EFT, just write out a check, stick it in the post box, wait for it to get delivered. Cool, I got my payment, right? That's how they work. Their credit cards don't have chip and PIN. Well, maybe they do now, but it's very recent if they do. Most credit cards don't have chip and PIN, so they have huge credit card fraud problems. It's bizarre. It's like this weird, backwards, antiquated financial system. It's really weird. We have an incredibly sophisticated financial system relative to the US, basically. They're like in the Stone Ages. I don't know why. Anyway. So it's regulated. Financial innovation. What drives financial innovation? Obviously, anything that's going to drive profits is going to drive your innovation. You know, I mean, you think about why would a bank not use EFTs? You can have less branches. You can have less ATMs. You can have less banking staff. You can cut all those costs by using EFTs, right? The more you innovate, I mean, your innovation is driven by your profits, essentially. Again, as I say, for some reason, we have a much more innovative financial sector than what the US does. And I think it has to do with the structure of our financial sector, which is very different to the US, because we only have like 4 major big banks, and they've got also about 5 major big banks, but like, I don't know, 100 or so smaller banks. So I think the structure of our system is just very different, and it enables us to be much more innovative. Cell phone banking, I'm pretty sure they don't have that in the US yet. South African Reserve Bank are the guys that, in our context, who do the regulation. What is it that the Reserve Bank does? What are their goals, right? Well, what they do is they control the money supply. In other words, they can adjust the quantity of money in circulation, okay? In other words, that means they have some level of control over money supply, right? And why they control the money supply, or what their purpose is in controlling the money supply, is to maintain or achieve and maintain some sort of price stability. In other words, in the South African context, we refer to controlling inflation. If you can control inflation, then you achieve price stability. In the South African context, you want to control inflation, and the South African Reserve Bank does that by manipulating the money supply. By adjusting the amount of money in circulation, you hope to control the level of inflation in the economy. So that's its primary mandate. Okay, so let me write that somewhere. Controlling inflation, call that the primary mandate of the Reserve Bank. It also does a bunch of other things. Its secondary mandate, so let's write here, secondary mandate is to try and promote economic growth. So first of all, it wants to control inflation. Then if inflation is under control and we're happy with that, then the question is the economy in a recession, for example? If the economy is in a recession, then the Reserve Bank has a mandate to try and get us out of a recession. In other words, promote growth. Okay? So first, control inflation. Then, if inflation is under control, do what you can to help growth. And it does, in doing so, what it does is it formulates some sort of monetary policy. In other words, its monetary policy is aimed at achieving price stability and secondary growth targets. So, monetary policy, that's what it controls, that's what it does, number one. The other things that it does, well, it actually issues banknotes and coins technically, except that coins are produced by the mint, not the Reserve Bank. Only the banknotes are made by the Reserve Bank. The coins are made by the mint, and the mint is a separate entity to the Reserve Bank. So apart from doing monetary policy and actually printing money, They also regulate, so they supervise the banking sector. That's their regulation role. Okay? And part of that regulation and part of monetary stability is ensuring that the payment system works. So that's why I said if a bank goes under, if the banking system goes under, that affects the payment system, right? So the reason that the Reserve Bank is interested in regulating the banking system is to make sure that our payment system continues to work without any issues. They also act as a banker for the government. In other words, the government holds an account at the Reserve Bank and can borrow money from the Reserve Bank in the same way that you or I might borrow money from Nedbank. And then they have this thing called the lender of last resort, which is interesting. So banker for government and lender of last resort. And lender of last resort is a very kind of special role that a Reserve Bank has, which allows them to intervene when a bank has a potential liquidity crisis. So what Yanni was telling us last week, or the week before, I can't remember, maybe it was last week, there's that recent issue where ABSA was coming under fire, I think by like the EFF and the public protector for some strange reason, saying that ABSA had made money out of a bank bailout that the Reserve Bank had been involved in, and that it was somehow a dodgy deal. And ABSA then put out a lot of statements basically to clarify that there was nothing dodgy about this, and it was just the Reserve Bank doing what the Reserve Bank does. And the public protector got very unhappy because they said this was a leaked investigation and things were released when they should not have been released, and the investigation was preliminary, and anyway, it was very confusing. But what the Reserve Bank can do is the situation I described previously, where a bank has assets that are long-term and has deposits that are short-term, and if a lot of people come and want to convert their deposits into cash, the bank has a problem in the sense that if it doesn't have enough cash available, it needs to sell assets. If it needs to sell those assets in a fire sale situation, in other words, it needs to get rid of them quickly, it's probably going to sell them at a loss. If it starts selling them at a loss, it's going to put the bank in jeopardy. In other words, if it starts making a loss, it might end up in a situation where it's not only illiquid, it's got a liquidity problem, where it's actually got a solvency problem. So instead of trying to fire sale the assets, what the bank can do is it can go to the Reserve Bank and say the following: I've got these assets, they're very good quality assets on my bank sheet. What I'd like to do, on my balance sheet, sorry, is I'd like to sell you these assets for a very brief period of time, 1 day, 2 days, a week, right? I want to sell you these assets today, and I'm going to buy them back from you tomorrow, or in 2 days' time, or in 1 week's time, right? In the meantime, you're just going to give me some cash, right? So the Reserve Bank buys those assets, gives the bank cash. Now the bank's got the cash it needs to pay for whoever's withdrawn the deposits. It's now got a day or 7 days or however many days to get extra deposits back into its bank, onto its balance sheet, get more cash. Now it uses that cash to buy the assets back from the balance sheet. Back onto its balance sheet, back from the Reserve Bank. So that's called either an overnight sale or a short-term sale, and that's the lender of last resort. That's what a central bank can do. Yes.
How does the Reserve Bank, how do they, I'm so sorry.
No, yeah.
What do they benefit from that?
So remember, why would the Reserve Bank do it? What is the benefit to the Reserve Bank? The Reserve Bank wants financial stability, right? So if there's a bank with a liquidity problem, right? It's got good assets, but its deposits, which are short-term, right, are being liquidated at a faster rate than it can liquidate its assets and still be profitable, right? Now, if it were to fire sale all those assets, the value of its assets drop. If the value of the assets drop, while the value of the liabilities don't, suddenly your liabilities are worth more than your assets. Now you're insolvent. If you're insolvent, as a company, you go out of business, right? And you get liquidated. Okay? The Reserve Bank doesn't want that to happen. Okay, so if the bank's got good quality assets, so the value of the assets are greater than the value of the liabilities, right? So there's some owner's equity making up the difference, right, and some profit. Rather than making the asset value drop, it just buys the assets at its current value, so it's not a fire sale, and gives the bank cash. The bank uses that cash to stay liquid, to manage its liquidity. Of course, when the Reserve Bank does that, right, it charges the bank. In other words, it doesn't just buy the assets and give cash for nothing. It charges them basically like a penalty fee. So it charges them a high rate on that cash. So if the bank has deposits and it pays people deposit interest rates of say 1%, right? That means that any deposits that you've got in there costs the bank 1% in interest. But it charges, say, people that it loans money out to at say 10%, right? There's like a 9% difference, right? If it has to sell those assets to the Reserve Bank will buy those assets, right, and give them cash, but will charge the bank itself like 4%. So instead of borrowing essentially deposits at 1%, it has to borrow from the Reserve Bank at 4%. Now that cuts into the bank's margins. It doesn't want to do that. So it'll only do that for as short a time as it possibly can. 1 day, 2 days, 12 hours, right? As short as a time as possible, because it's costing them money to borrow from the Reserve Bank. In fact, the banks can also lend to one another in a very similar situation. And you have something called the repo rate, which is the repurchase rate, which is the banks do exactly the position what I've described to you. If there's one bank that needs more cash, so if there's a bank that has less cash than what it needs, and another bank that's got more cash than what it needs, those two banks can enter into an overnight sale where they just basically lend each other that excess cash. And they charge each other a rate that's different to what the deposit rate would be, but also different to what the Reserve Bank rate would be, so that they make money out of the transaction without having to worry about the Reserve Bank. Yeah, it's very clever, yeah.
Can the government bank at commercial banks?
Mm-hmm.
Oh, so they don't have to bank at the Reserve Bank?
No, they don't have to. And usually if it's like at a municipal level, then it'll, the municipality would normally work with the bank, because the bank would do the transactions that the municipality, does, right? But the central government, for example, would operate through the Reserve Bank, because the Reserve Bank has accounts with every other bank. So if the government operates through the Reserve Bank, it's easier then to, operate with interact with all the banks via the Reserve Bank. Whereas at a municipal level, you just do your normal like day-to-day banking kind of stuff that we would do. That would be with a particular bank. Then those municipalities can have bank accounts with whoever they want. Yeah.
Do they bank with foreign banks?
Does who bank with foreign banks?
Or if a municipality or government choose to bank with foreign banks?
No one is allowed to bank with a foreign bank except the Reserve Bank. And even the Reserve Bank doesn't bank with a foreign bank. They just interact with. In other words, what will happen is our Reserve Bank holds foreign currency, and other Reserve Banks hold our currency, right? And when we purchase currency, foreign currency, we purchase it directly from other Reserve Banks, right? So that's the kind of interaction that happens. So if you are the government in South Africa and you want to purchase something from overseas, you would operate through our Reserve Bank, who would operate through the Reserve Bank of that other country, right? But you as an individual can have a foreign bank account, for example. And there's nothing to stop like an individual who works for government from having a foreign bank account. But our government does not, as an entity, as an institution, have a foreign bank account. Because it operates through its own banker, which is the Reserve Bank, who then operates with whoever it needs to operate with. Yeah. Alrighty. Cool. Let's have a quick break there.